Right. Well, I will start now that the clock has passed 11:00 sharp, and welcome you to this launch webinar event for our annual report, annual market monitoring report on wholesale electricity market developments across the EU. My name is Christian Singlerson. I am the director of ACER, and I will be introducing in a few minutes those who will go through the main elements of this year's MMR, this year's market monitoring report, as well as some other speakers who will come in and complement in this 1-hour session. Maybe if we start with some of the practicalities, so next slide, please, on some of the housekeeping rules or the meeting rules. I think these will be familiar with many of you by now, as we have become accustomed to having these launch events virtual. First of all, please note that this webinar is being recorded. It is meant to be an interactive one, at least towards the end, where we're mindful to have approximately 20 minutes for Q&A. You do not have to wait with your question until this Q&A session starts. Rather, you can pose your question continuously, but please do so in the chat. And please remember to be concise, so not very lengthy, and also indicate at the beginning the topic, which makes it much more easy to structure the replies in the limited amount of time we have available for the Q&A, which will be at the end of the webinar. And just to note that the slides that we will be going through in a few minutes will be shared with you, and we'll try to send it around by email, but it will also be available on the website alongside the actual MMR report itself, which many of you, I would assume, have maybe had a chance to have a very brief look at. Maybe we turn to the next slides. I would just say very briefly about today's event by way of background. Our market monitoring report is very much a flagship item, a flagship report for us as ACER and CEER. We see it and we approach it as sort of the reference for the state of the integrated energy market in Europe. And the MMR was recently consolidated in 3 volumes between ACER and CEER, gas wholesale, electricity wholesale, and retail and consumer protection. And today's launch webinar is, of course, on electricity wholesale, so the big one right there in the middle. As it is a monitoring report, it is analytical by design, it is data-driven. It is also inherently looking back at the period in question, and this is, of course, 2020 that we're looking at. Nevertheless, given sort of the very unusual developments this year, and actually also last year, but the comparison between this year and last year, we have added a few elements from 2020 at the very beginning, where we're drawing on a recent note on the high energy prices that we issued in the middle of October. I think Thomas will speak to that in a second. Moving then on the next slide to the agenda, which I'll talk you through very briefly. I'm almost done with my bit, and then we will have a highlight run through of this year's MMR, wholesale electricity market MMR, between Thomas and Christina in our electricity MMR team. Thomas will kick off with some key findings. We have a focus topic this year. It's the inaugural barriers monitoring effort, which we've doing for the first time, and Christina will go through that at length. And Thomas will round us out with some of the main recommendations in 4 different categories coming out from this year's report. Then we have asked Anna Maria from the European Commission to come in and provide some thoughts on how some of these findings and recommendations relate to future EU policy challenges and priorities. Christophe Chancreux, who heads the electricity department, will moderate the Q&A session, where we aim at roughly 20 minutes. And Annegret Gröbel, president of CEER, and with our and with the German Bundesnetzagentur, our colleague in the BOR, will conclude this 1-hour webinar. So that's what's in store. And without further ado, maybe I turn to you, Thomas, to kick us off. The floor is yours.
Thank you, Christian. Good morning, everyone. So, as Christian just said, I will first present the key findings concerning this year's monitoring of wholesale electricity markets. Christina will then detail the analysis on barriers to market entry and price formations, included for the first time in this report. And I will conclude with our main recommendations and expectations. So in the next slide, please, I will start with an overview of the report. The report consists of 3 parts. Part 1 outlines electricity market trends in 2020, that is, key developments in electricity wholesale markets across Europe and the evolution of electricity prices. Part 2 focuses on developments in the internal energy market, assessing, among others, the level of cross-zonal capacity made available for trade and its efficient use, the volumes and costs of remedial actions used by system operators to address network congestions, and the evolution of market liquidities across timeframes. Finally, Part 3 marks the beginning of ACER's collaboration with the Energy Community Regulatory Board and includes, for the first time this year, an overview of progress made by countries of the energy communities regarding the implementation of energy market rules and associated benefits. So we will first have a look at market trends in the next slide. As Christian said, this report is on 2020, but there were changes in 2021. That's why our first observation on the year 2020 actually relates to 2021. As you know, 2020 saw a significant drop in electricity demand and prices driven by the pandemic. But recently, however, we've been observing the opposite trend as a consequence of unusually high prices for gas. Gas prices in early October were 400 times more expensive than in April this year. So this is to say that, of course, we welcome questions on recent events, but we wanted to mention that the issue of high prices is tackled in a dedicated note by ACER from October this year. And this is why we display the link of the publication on the slide. Now, today's report focuses on 2020, starting with the next slide. How did the pandemic affect ongoing efforts to integrate markets? Well, we did not observe any sign of a slowdown and would say that despite the pandemic, the power market integration continued at pace. As you can see in the figure, we looked at the volumes of energy traded intraday through single intraday coupling from 2017 to 2020. And we see that the amounts of energy exchanged across border remained higher than pre-COVID levels. This is important, as this is key to facilitating the integration of renewables. Next slide, please. So, market integration progress, but where do we stand overall regarding market integration? The figure here displays coupled areas in the day-ahead time frame, on the left as it was in 2010 and on the right today. Here again, we see a rather positive overview. We see that the majority of countries are part of the same coupled areas as the result of the progressive extension of day-ahead market coupling. The same observation applies to intraday market coupling. Now, further integration is expected with the implementation of the so-called flow-based market coupling in Central Europe, but as you know, it has been facing delays. You will see further elements of market analysis in this year's report, but for this presentation, we decided to detail a new and important topic. This is why I now give the floor to Christina, who has been leading the effort on the study of barriers to price formations and market entry. Christina, the floor is yours.
Thank you, Thomas. And good morning, everyone. Well, as mentioned, this is the first time that the 2020 MMR includes a new chapter on barriers to efficient price formation and easy market entry and participation for new entrants and small actors. One of the main questions, or one of the first questions you may have, is why we have enlarged the scope of the MMR. And basically, the reason is that we aim to meet a new monitoring task set in the Clean Energy Package that requires ACER to monitor, among other topics, state interventions preventing prices from reflecting scarcity and regulatory barriers for new entrants and small market players. So today we are going to present very briefly the assessment of these barriers across the member states in 2020. But it's important to note that this assessment is based on an external methodological study that we conducted with the assistance of DNB, where we identified the specific barriers, the indicators, as well as the methodological approach. So now let's move to the next slide. So before showing the results, it's important to understand that the scope of the analysis is relatively wide. In a nutshell, to identify the barriers to efficient price formation, we consider price formation in both energy and capacity products in all market timeframes, and any requirement or market design feature preventing prices from being cost reflective, so from reflecting the real value of electricity, as well as any restriction as a result of insufficient market integrity and transparency, is considered as a barrier. To identify the barriers for new entrants and small actors, as new entrants, we mainly consider new business models aiming at providing flexibility to the electricity system, new technologies, and market players with experience in other markets, for example, energy efficiency services, software development, and so on, who aim at entering the electricity markets. As small actors, we consider those without economies of scale. And any discriminatory, arbitrary, or avoidable requirement imposed on these market participants has been considered as a potential barrier to their entry and participation. So what barriers have we analyzed in the 2020 MMR? Well, in the methodological study that I mentioned before, we identified 17 barriers, but in the 2020 MMR, we have analyzed 11 that we chose based on two criteria. Firstly, a higher weight or importance according to stakeholders' inputs collected in a public consultation that we conducted last year and some NRA's feedback. And secondly, a higher data availability in the underlying indicators and questionnaires. It's important to note that, as you can see in the center of the slide, some barriers are relevant for both, for efficient price formation and for new and small market players. And in the upcoming MMRs, we intend to analyze progressively the remaining barriers highlighted in blue here in the slide. So let's now see the overall performance of the member states in the barriers analyzed in 2020 MMR. Very briefly, how did we get these final scores? Well, we analyzed more than 50 indicators, which were normalized and aggregated to get a final score per barrier, ranging from 0, corresponding to the worst score, to 1, corresponding to the best score. And we have considered that only when the final scores are lower than 0.6, the aspect analyzed can be considered as restrictive to a greater or lesser extent. Here it's also important to note that despite some member states show a satisfactory overall performance, it doesn't necessarily mean that they perform well in all the underlying indicators, especially in barriers measured with a high number of indicators, for example, potential restrictions in balancing markets. There can be some underlying severe restrictions, although the overall performance is okay. Of course, in this presentation, we cannot give a detailed explanation of each barrier and all the underlying indicators, but we are going to try to give some insights of the main outcomes. So let's start with the most common barriers to efficient price formation. First, with a few exemptions, in particular, as you can see in green in the map, Germany, Denmark, Finland, Italy, and Norway. What we see is that in 2020, most member states showed a low competitive pressure and liquidity in their wholesale markets. This barrier becomes more severe in 8 member states, highlighted as moderate or orange in the map. And why is this? Well, because almost all of them have a higher market concentration. And in the case of Hungary, Belgium, and Czech Republic, they have a low liquidity in their forward markets. In addition, under this barrier, we identified that in the case of France, Romania, Ireland, and Italy, they require some domestic generators to sell a share of their electricity production at regulated prices. And this is a measure that may reduce the competitive pressure in their wholesale markets, thus affecting their liquidity. Secondly, one of the main barriers to the integration of electricity markets is the lack of sufficient capacity available for cross-tonal trade. Here we assess how close the TSOs were to reach the minimum legally binding 70% target in 2020. And as concluded in previous ACER reports on the 70%, we observed that the TSOs of the core region, in particular Germany and Poland, and those in Italy, Bulgaria, Croatia, Hungary, and Romania need to make the biggest efforts to meet the minimum 70% target. Let's see now 2 aspects that may impact the price signals for consumers and as a result, the efficient price formation. Firstly, some end-user price interventions, especially regulated prices, may represent a barrier to efficient price formation. Although we understand that in a context of unusual high energy prices, policymakers face a dilemma on how to, on the one hand, best protect the most vulnerable consumers from undesirable economic consequences, while on the other hand, preserve the role and value of the price signals. Nevertheless, it's important to remember that end-user price interventions are allowed under EU's legislation only in exceptional situations and under strict conditions, as set in Article 5 of the Electricity Directive. What we observe in our analysis is that 12 member states had some type of end-user price intervention in 2020, and overall, the level of penetration of such interventions was high. The potential impact of these interventions on efficient price formation was found more restrictive in France, Hungary, Romania, and Slovakia, because all had price interventions for some households, but most importantly, because more than 50% of their households had some price interventions, and most of these consumers were not defined as vulnerable. Secondly, we analyzed the accessibility and incentive to contract dynamic retail prices. Well, it's clear that dynamic retail prices can bring benefits to both the consumers and the network from an operational point of view, and they can contribute to a more efficient price formation. But it's also important to highlight that consumers need to be fully aware about the potential benefits and drawbacks of such contracts. So what matters is that those consumers who are fully aware and interested in providing demand response have the choice to do so. In our analysis, we observed that the possibility or the incentive to contract dynamic retail prices is generally limited, especially in Central and Eastern Europe, for two reasons. Firstly, because the rollout rate of smart meters in all these member states is low, actually lower than 30% of households. And secondly, because in some of these member states, consumers receive low incentives to adjust their consumption, since the share of the energy component in their electricity bill is low, and the price differentials between, for example, the peak and non-peak hours are also limited. Let's move now to the next slide, to the most common barriers for new entrants and small actors across the member states. Well, one of the most common barriers is the lack of a national legal framework. In particular, our analysis focuses on active consumers, aggregators, and citizen energy communities. And what we observe is that based on data provided by the NRAs, at the end of 2020, only Germany, Denmark, France, and Hungary had defined the main roles and responsibilities for these market players and allowed their participation in all market timeframes and DSOs products. Secondly, the analysis of some indicators on the structure, behavior, and performance of the retail markets shows that the competitive pressure in many retail markets still has a lot of room for improvement, especially in 10 member states where this barrier was found moderate, since their retail markets are highly concentrated, and in some cases, for example, France and Greece, the entry-exit activity in the last 3 years was also found low. In addition, in the case of Poland, Belgium, Slovakia, Hungary, and Greece, we also found that there is a negative correlation between the energy component of retail prices and the wholesale prices. And thirdly, we analyzed a long list of requirements and design features of balancing markets, in particular some parameters that were originally designed in a context of centralized production and are not aligned with the European target model yet. So they may hinder the energy transition, limiting the participation of demand-side response, decentralized production, and energy storage in a high number of member states, as shown in the third map. Well, some examples of these indicators analyzed were large minimum bid sizes, restrictions to aggregation of load, or long procurement lead times. And last but not least, it's also important to note that the wide use of end-user price interventions and the impossibility or the lack of incentives to provide dynamic retail prices may also represent a barrier for new and small market players. Let's focus now on some barriers that are less common across the member states, but they are still relevant for some of them. Firstly, in 2020, the Italian and Iberian day-ahead and intraday markets still had the bidding limits. Secondly, the current delineation of bidding zones does not always reflect structural congestions, which leads to inefficient price signals, and this needs special attention in the case of Germany. Thirdly, we also analyze how some design features of the balancing markets that are not in line with the target model yet may also impact price formation. And this barrier was found in around half of member states, becoming more restrictive in the case of Slovakia and Croatia. Fourthly, the participation of demand response, variable renewables and energy storage is still very limited in the capacity mechanisms. Actually, in some capacity mechanisms, some technologies are not allowed to participate. For example, in the now phased out Greek capacity mechanism, which didn't allow renewables and energy storage. While in other capacity mechanisms, where theoretically all technologies can participate, what we say is that there are some features such as large minimum bid sizes or restrictions to aggregation that may exclude de facto demand side response, energy storage, and small renewable generators. And this barrier was found more restrictive for Germany, France, and Greece. And last, we analyzed the level of transparency of the capacity calculation methodologies and the level of completeness in some data provided by TSOs through the ENSOE transparency platform, and also to ACER so that we can monitor the 70% target. And we observed that some TSOs, especially in the Baltics, Sweden, and Ireland, still need to make more efforts in information sharing. So to finish my intervention, what are our specific recommendations to mitigate the barriers presented? Well, regarding the member states and entities, firstly, they should remove explicit wholesale price restrictions to guarantee a more cost-reflective price formation and increase the level of competition and liquidity in wholesale markets. They should also review the requirements and features of some capacity mechanisms to make sure that variable renewables, energy storage, and demand response can actually participate. Member states should also transpose the Electricity Directive as soon as possible to define the roles and responsibilities of the new and small market players and allow their participation in all markets and TSOs and DSOs products. In line with the Electricity Directive, member states should also protect vulnerable consumers by ensuring that markets continue to deliver efficient price signals. And to allow demand response, they should also speed up the penetration of smart meters and reduce the taxes and levies in the electricity bills. Regarding the TSOs, they still need to make more efforts to meet the 70% target and perform an unbiased, sound, technical, and neutral bidding zone review. They should also ensure that the pre-qualification requirements and design features of balancing markets allow the participation of new and small market players. And last but not least, some of them also need to make a few more efforts to increase the level of transparency in information sharing. And now I give the floor to my colleague Thomas, who is going to present the main recommendations of the report.
Thank you, Christina. So Christina already listed the recommendations concluding the barrier studies. These recommendations constitute one of the 4 groups of recommendations issued in the market monitoring report, and I will now detail the other 3 groups before concluding. So in the next slide, the first set of recommendations aims to increase the amount of cross-zonal capacity. The clean energy package identified insufficient cross-zonal capacity as one of the main barriers to market integration. As you know, market coupling implicitly relies on cross-border capacity available for trades. Even when available cross-border capacity is used efficiently, if this capacity is scarce, market coupling and associated benefits remain limited. So this is why the clean energy package includes the requirement for member states to guarantee that 70% of the cross-border capacity should be made available for trade. This requirement applies since the 1st of January 2020. And on the figure, you see where we stand today. So as you can see, although we observe steps towards an increase in cross-border capacity available for trade, we are still far from meeting the 70% target. Now, there is not a single solution to reach that goal. It's possible to invest in the network, which should be done in a cost-efficient manner, to apply more remedial actions, or to redefine the borders of the bidding zones in order to better reflect internal constraints. In that context, ACER recommends implementing the methodologies for coordination of redispatching and counter-trading and related cost sharing, finalizing the amendments of capacity calculation methodologies to ensure that the 70% capacity target is met, and performing unbiased, sound, technical, neutral bidding zone reviews. Now, in the next slide, the second group of recommendations aims to ensure the effective completion of the integration progress across all market timeframes. The figure displays in the blue section of the horizontal bars for the day-ahead, intraday, and balancing timeframes, the percentage of the time when interconnectors were used efficiently in 2020. So the yellow sections represent room for improvement. Thanks to market coupling, the cross-border capacity that is made available via interconnectors, although limited, as I mentioned in the previous slide, is used very efficiently in the day-ahead time frame. Now, the level of integration of the intraday and balancing markets is still not as high as the day-ahead markets. This is important because liquid and well-functioning intraday and balancing markets are key to giving market participants the ability to balance their positions closer to real time and thus facilitate the integration of renewable energy sources. From this perspective, continuous trading without pricing of the cross-node capacity should be improved. We calculated that accomplishing market coupling in all timeframes across EU borders would render an additional welfare benefit of more than 1.5 billion euros per year. And despite recent progress, we maintain as a recommendation to finalize urgently the implementation of the single day ahead and single intraday market coupling, the common grid model methodologies, and the electricity balancing guideline. ACER further maintains the recommendation to investigate improvements to the forward markets to ensure sufficient hedging opportunities to market participants. Now, moving to the next slide. So we skip the third group of recommendations in the report, which concerns the barriers to price formation and market entry and was detailed by Christina. I will present the fourth group of recommendations on adequacy. System adequacy refers to the way in which the power systems can match evolution in electricity demand. The challenge is for the power industry to ensure the security of supply at all times. The main message here is the importance of increased coordination. One solution to security of supply is to introduce rewards to producers for making capacity available in the form of capacity mechanisms. On the left, the map shows current coexisting approaches to capacity mechanisms, and next to the map, associated costs at European level. So the map reveals a lack of harmonization, while associated costs are expected to increase as more countries will use market-wide capacity mechanisms in the coming years. We recommend establishing an appropriate reliability standard and performing sound adequacy assessments at the European and national level, in line with our corresponding ACER decisions. We further recommend adopting capacity mechanisms only where resource adequacy issues are forecast. Now, another mean to ensure security of supply is displayed on the map on the right, providing an overview of interruptibility schemes in Europe. Interruptibility schemes normally refer to national programs dedicated to demand-side response, whereby TSOs remunerate large industrial consumers for temporary load interruption or reduction. And here, as for capacity mechanisms, in order to avoid market fragmentation, we recommend to integrate the service related to interruptibility schemes within existing procurement channels. And dedicated interruptibility schemes should only be left to cases where no parallel procurement channels exist or where there is a need to kickstart the development of new products or service for demand-side response. Now, in my next and final slide, you see a reminder of all 4 groups of recommendations. I will not read them, but as a conclusion, I will recall the main messages of this year's report. Further market integration remains key, be it in the context of COVID and the needed network resilience, or in the context of decarbonization. We saw this year again some progress, but also some delays in implementation, and have not yet reached a fully integrated electricity market. We single out 2 short-term priorities. First, market coupling, with the implementation of the flow-based project in Central Europe, and second, the performance of robust adequacy assessments to enable a more efficient approach to security of supply. Thank you for your attention.
Thank you very much, Thomas. Excellent run through both from you and from Christina. This is where we shift a little bit to the, well, not the fully outside perspective, but the, shall we say, non-ACER perspective. I've asked Anna Maria Macci, the deputy head of unit DG Energy in one of the main units that we work with, to present the perspective from the European Commission on how some of these findings in this year's market monitoring report relate to some of the future challenges that you may be working on, or that the Commission more broadly might be looking at. So I turn to you, Anna Maria, and the floor is yours.
Thank you, Christian, and good morning, everyone. I would like, first of all, to thank ACER for an insightful report, and Thomas and Christina for the presentation. The report shows the importance of liquid, integrated, and well-functioning energy markets for the clean energy transition. Now, the decarbonization of the EU electricity sector is not only crucial to reach the EU's climate objective, but is also the best insurance against price shocks in the future, as the current circumstances demonstrate. The integration of European markets in all time frame is essential for the transition. As it was also mentioned during the presentation, it allows the full exploitation of renewables, it promotes investment in clean technologies, and it ensures security of supply at the least cost for consumers and businesses. The report outlines the considerable progress that has been made in the context of market integration. Just over 1 week ago, another very important milestone has been reached with the coupling of the Bulgarian-Romanian border. And let me take here the opportunity to congratulate the member states, regulators, NEMOs, the TSOs, and all the stakeholders involved who have made this possible. As Thomas just recalled, the report also quantifies the welfare gains that additional integration would bring, and the figures are impressive. Therefore, any delays in the implementation of market coupling and the rules on cross-border trade are a missed opportunity and a welfare loss for consumers. The full and timely implementation of the clean energy package, network codes, and guidelines remain key. In addition, ACER and the Commission are also assessing whether amendments to the existing rules, and in particular the CACM network code, are needed in order to smoothen the implementation of the clean energy package and to make the framework fitter for the future challenges that the European electricity markets will face. Besides market integration, the report also highlights the importance of well-functioning electricity markets as a tool to increase the reliability of the electricity system and foster its decarbonization. To that end, as we heard, the market design should attract new players, such as new flexible capacity, new technologies, and small actors, including consumers. The new chapter on market entry is therefore extremely timely and relevant. It identifies the barriers that hinder the development of those actors and provides recommendations on how to remove them. Again, we can overcome most of those obstacles by accelerating the implementation of the existing internal market legislation. It may also be necessary, though, to complement the legislative framework, and this is why the Commission has started to work with ACER on a possible new network code to support the development of demand-side flexibility. So to conclude, I would like to congratulate ACER again on its 10th market monitoring report, which shows the very important role that market monitoring plays in the energy transition, and probably this role will become increasingly important in the years to come. Thank you very much.
Excellent. Thanks a lot, Ana Maria. I would very much second that. Also, your last point about market monitoring becoming more and more essential. It's a complex overview with, very significant repercussions. And so market monitoring will remain key, and increasingly so. I completely agree. Excellent. Now we are actually more or less on time, perfectly on time, which is great. So Christophe, I think you will moderate the Q&A where we have approximately 20 minutes, thus leaving some time for Annette to conclude this webinar. So over to you.
Thank you, Christian. Good morning to everyone. So I would like again to invite you to put your question on the chat box. We received already a few of them. Thank you very much for that. Maybe I will start with the first question from Julius about the interconnection capacity. He raised the issue that the Iberian Peninsula is considered as an isolated area from the rest of Europe, while in our market monitoring report, they seem to perform relatively well in terms of capacity made available to the market. Maybe Rafa, maybe you could address this question.
Yes, hello. Good morning to everyone. I hope you can hear me. Is that the case,
Yeah,
Christophe?
yeah,
Can you hear me? Yeah. Okay, good. Thank you. Yeah, so the question is relevant. So indeed, I think that there is a need to make a distinction. I think that we tried to make it in the report, but perhaps it was not so easy to make it here so explicit. So a distinction between what is a target for the level of physical capacity that all member states could have at some point in time, subject, of course, to some cost-efficient analysis. So, for example, the 15% target to be met by 2030, that was mentioned as relevant in several occasions by member states. And a second element of analysis is how much of whatever level of capacity is actually offered to the market. And this would be the 70% well-known target. And this refers to how much is actually offered from how much is physically there. It is the second part on what we focus here, because it's actually something that can be addressed in relatively shorter time as opposed to investing in physical capacity. But yeah, having said that, it is true that the level of interconnectivity across Europe is well known to be different across member states. And indeed, this can explain in occasions the different level of prices. But from a purely efficiency point of view, here we are focusing on the share of capacity offered to the market. Thank you.
Thank you, Rafa. We will come back to the 70% because I see that there are a number of questions on this issue. But maybe I will continue with the next question from Carlos. It's not really a question, but Carlos raised the issue of this political dilemma to expose citizens to volatile spot prices. Maybe Christian, you want to say a few words about this political dilemma?
Absolutely. And I would start by agreeing that, of course, there is a dilemma. On the one hand, there is a political priority in many quarters in Europe to shield the most vulnerable from what is deemed excessive prices. And on the other hand, I think most recognize that one needs, more generally speaking, price signals to drive certain desired behavior, whether it's greater efficiency or investment in a particular direction. So we also try to point to this dilemma as a broader dilemma, both in the market monitoring report, but also in the high energy price note that we issued in mid-October, which Thomas was referring to in the beginning of the presentation. So there are different elements to take into consideration how balancing this. First of all, how to delineate the vulnerable groups that one wants to protect politically, and others to make sure that those that are exposed or could be exposed to significant fluctuation in price, whether it goes up and down, are fully informed of the benefits and risks. One needs to be diligent in how one uses default options for such types of exposure contracts. And there's probably also issues on how to approach retail suppliers more broadly from a regulatory stance, so as to make sure that there is a healthy risk exposure from that side as well. So it is a dilemma, and I think many governments and regulators across Europe are looking at it, exactly acknowledging that it's a dilemma. Thanks.
Thank you, Christian. The next question is from Libridge. It's about the slide on information sharing, and the question is whether what do we suggest or propose to create more transparency on this information sharing? What do we propose in practice? Maybe Rafa, you want to address this question?
Yes. So in the report, we do not focus in all aspects of transparency. In this specific case, we focus on the information provided by TSOs to the market mainly. And it's our understanding first that there has been improvements in recent years, in particular when it comes to for example, the transparency platform. I think it was a good incorporation and a good tool for the market. Nevertheless, there are a number of areas on which we see improvement. Perhaps the first one is actually on the transparency platform itself. Despite improvements that have been clearly seen, I think that we believe that there are still areas or some data items and some geographical areas where the data can be better, and we believe this is important. We also believe that there is a need to have clearer, stronger provisions on sharing and publishing information about the situation of the network, for example, about the location of congestions, and the capacity calculation methodologies can play a good role on that. In that respect, we can also mention that it would be good to adopt best practices. As a way of example, we see that flow-based, as applied in Central West Europe, despite its complexity, it has a number of advantages, and one of, not necessarily the main one, but it's one good advantage is that it illustrates more transparently to the market where the locations are taking place. Additionally, maybe as a final remark, I think it would be good, and this is maybe a joint effort of TSOs on the one hand, but also regulators, is to put transparency as a key task, as opposed to have it as a complementary one, as it happens in few occasions. So that would be the set of actions that could be made in that respect. Thank you.
Thank you, Rafa. Maybe I will turn now to Magnus' question, and maybe this is for Christian. It's about the absence of volatile price, which under a negative classification, because it does not create incentives for dynamic contracts. Any views, Christian, on this?
Yes, thanks. So I would say no, not necessarily. Does not necessarily render a negative classification. So on the way we perceive it is, on the one hand, lack of price differentials may indeed deter the benefits of demand-side response, but that does not imply in and of itself that there's anything wrong with it. The issue is more whether this lack of volatility is artificially induced or not. And I guess one practical example there is the jurisdiction of Norway, which has low volatility for a number of reasons and has a good use of dynamic pricing. So in that sense, Norway is more advanced, if you will, in this type of classification model, most likely due to a combination of different aspects, including consumers being comfortable and well-informed in entering into these types of contracting regimes, and with a high level of transparency. So that's how I would approach that. Thanks.
Thank you, Christian. Then there are a couple of questions on the 70%. Maybe I will start first with Kilian question for Rafa. Kilian's question is about the whether we take into account in our assessment the fact that some countries apply action plans and our derogation. So is this are these measures taken into account in our assessment of the 70%?
Yeah. So in short, yes, but the caveat is the following. So what we understand is important is to compare on equal footing all member states in that respect, because at the end of the day, the target will apply sooner or later, irrespective of action plans. So what is crucial is indeed to see the progress of member states with regard to the target. This is why we put all member states in light of the target, but from a purely compliance point of view, I would agree with the statement that those countries that have action plan have indeed the possibility to progressively meet the target, and we put it as part of our assessment, with the condition, of course, that the sufficient data is there. This is normally the case for actions plans, but is not always the case for derogations. Sometimes derogations come with some interim targets that can be monitored, and some others they don't. In the absence of those, it is very difficult to monitor the targets in the derogation. The only thing that can be done is to monitor with regard to 70%. Thank you.
Thank you, Rafa. Another question from Hugo on the 70% and how will this requirement impact the Swiss borders?
Well, in that respect, I think that the answer could be similar to any other country that is non-EU country. So in short, non-EU countries are not per se required to meet the 70% rule on their borders, so on the exchanges across their own interconnectors. What can be done, and I think that there were in previous webinars, we explained also the European Commission position about the topic. So if there is a reasonable coordinated capacity calculation framework between the non-EU countries and the EU countries, exchanges with those third countries can be considered as part of the 70%. So it would account as exchanges contributing to meet the target.
Thank you. Another question on the 70% from Magnus. Why would the 70% apply only to interconnectors and not to national cross-zonal transmission line?
Maybe this is a matter of clarifying without going into all technical details. So a priori, I mean, maybe two clarifications. One is first we analyze, or the 70% target is formulated in such a way that TSOs have to offer 70% capacity in all lines that are relevant for capacity calculation, are relevant for exchanges. And this is irrespective of the location of the network element. So if an internal network element is limiting cross-zonal capacity, this is also monitored by us as long as there is sufficient information. So the fact that the focus is on exchanges does not mean that the underlying network elements are also can be internal or interconnectors. And finally, this is something that we did not put focus on, but I think it's still part of the 70% for those countries. Few, because actually there are not a lot that have internal bidding zones, namely Sweden, Denmark, and Italy. A possibility exists to also monitor the 70% within those bidding zones, and also the contribution of exchanges within those bidding zones to the 70%. And we will be doing that as well. Thank you.
Thank you very much, Rafa. Now there is a question on the energy prices, maybe for Christian, and it's a question from Jose. What do we think about the controversy, the recent controversy raised by some country like Spain regarding the appropriateness of the pay-as-bid marginal pricing? Christian, any?
Yes, thanks a lot.
This?
Yeah, thanks a lot. So I would say in our high energy price note that we issued in the middle of October, which Thomas was referring to in the beginning, and where there's a link to the note on the slides, We include some considerations on the marginal price of the pay-as-cleared system as such, whilst not pronouncing ourselves on one specific member state. And what I would mention here for the purpose of your question is maybe threefold. First, I think most would probably recognize that the pay-as-clear model is the most efficient vis-a-vis its alternatives, given the incentive for those who enter the market to bid one's marginal cost, as opposed to try and figure out what might be the highest bid, which would be kept within the merit order. As such, it also facilitates new entrants because you basically have to know your marginal cost, as it were. Secondly, given the trajectory of the European energy system, and by extension the electricity system, it's likely that many of the new additions for electricity, new generation, will be obviously low carbon technologies, but they will also be low carbon technologies which will have relatively high capital costs and low operational costs. So there's a need to have a market system which allows for significant revenue to be claimed above one's marginal cost. Otherwise, they will not be in the market longer term, at least on market terms. And the final thing I would add is, I think it is generally quite difficult, not least for those types of technologies, to sort of deem exactly what are deemed unfairly high profits, if I can use that type of term, vis-a-vis what is legitimate capital cost recovery. That makes that type of approach traditionally quite difficult. That's what I would add at this stage. Thank you.
Thank you. I will move now to the question raised by Gérard, maybe for Thomas. It's about the question about the slides showing the efficient use of available cross-border capacity in the different time frames. Thomas, maybe you want to clarify the meaning of these slides?
Yes, so for these different time frames, what we look at is the percentage of the time the interconnectors are used in the economic direction, meaning from low to high prices, and this is what we obtain. I hope I'm not too brief on the answer, but I'm happy to develop further.
The question was whether the target is to reach 100% for each time frame, and why? How is it possible to reach 100% for each time frame in the day-ahead, intraday, and balancing time frame?
Okay, thank you. The issue, as we mentioned in the report, the central issue is market integration, and we believe that market coupling is the solution. Indeed, the goal of market coupling is precisely to ensure that all transactions are performed in the economic direction. So meaning that then we would have a fully efficient use of the tradable capacity. So indeed, the objective is to have 100% in all time frames, but meaning 100% of the transactions in the economic direction. And so the solution to achieve that is a fully complete market integration via market coupling.
Okay, thank you. Maybe a question from Julius. I don't know who could answer this one. Why does ACER no longer include a traffic light map to provide an overview of cross-zonal capacity across Europe, as we did in 2017? Maybe, Rafa, you want to take this one?
Yeah, I mean, I do not remember if it was a traffic light or it was some annex where we listed the borders and the level of capacities. But maybe the short answer is that since the 70% target is in place, or it was already about to be in place, we started to shift a part of the analysis on on cross-zonal capacity to dedicated reports. So in addition to this market monitoring report, there are dedicated reports that we are publishing now annually on the level of capacity across borders. And there you could possibly find, if not exactly the same figures or the same tables that were in 2017, some equivalent, knowing that now the framework has changed a little bit and sometimes the focus is no longer, for example, in Central West Europe, is no longer on individual borders, but the focus is on a set of borders that are coordinated among them. Thank you.
Thank you, Rafa. Then there is a question on market liquidity from Betnar, maybe for Christina. Why do we consider that low liquidity of the long-term market, why do we consider this as a barrier while at the same time the regulation pushed to buy and sell on short-term market?
Thank you, Christoph. Here I have to clarify that to measure the liquidity as a barrier, or the lack of liquidity as a barrier, what we did is to create a kind of composite indicator or our overall liquidity index, where we assessed the churn factors in the day ahead, intraday, and forward markets. I think here Rafa can complement because.
Yes. So thank you, Christina. Maybe to complement a little bit in addition to what you said very correctly, that the assessment of liquidity is a combination of different timeframes. Maybe to say that indeed there is always a tension or a dilemma between short-term efficiency, which has always been a key priority in electricity wholesale markets, as electricity is not storable, at least not in large scale. And this has actually been the biggest focus of market integration, while at the same time to ensure that there is sufficient liquidity or adequate levels of liquidity in forward markets for to cover the hedging needs of market participants. So the answer would be both are key. So we are not taking here a choice, is mostly like highlighting that in particular in some markets, forward market liquidity is low for a number of reasons that may go beyond of today's webinar, but that would be an overall answer to this question. Thank you.
Thank you. I think there are still a number of questions, but they seem to focus mainly on the high energy prices. Which was not necessarily the topic of today's webinar, and I suggest that for this question to wait a bit for the report that ACER was recently tasked to do, and that we will publish in April. Yeah, I propose to stop the Q&A session now and maybe to give the floor to Annegret, who will have some closing remarks. Thank you very much for your participation.
Yes, thank you, Christoph, and the whole team, and of course also all the interesting questions. And I try to conclude a little bit. I think the overall message and the overall lessons learned that we can take away is that, of course, last year was a special year with the pandemic, and at the same time also the efforts had to be stepped up to transpose and implement the new framework, the clean energy package. And I think given the stress test that the whole system due to the pandemic has undergone, the progress is slower maybe than we hope and than we expect, but at the same time we can probably also conclude that there is progress in a number of areas, and that overall the system and the approach, the rules and regulations work, I think, as they should. And I think the things that need to still be done and is indeed to accelerate the implementation of the new framework, as also the Commission rightly said, to unlock the benefits for consumers in particular fully. I think that is let's say the message I would like to make. That the stress test has been passed, but that we also see that more has to be done to meet fully the targets and the goals of the framework. In particular, of course, a completely integrated internal energy market or internal electricity market. Let's say that was kind of a general message that I would like to draw. The other thing is that, of course, we now see for the first time the use of the new instruments, the new network codes, the new rules. And we see that it takes time to design them, to draft them, and of course also then to implement them. But again, I would say that the start has been made, and more efforts, of course, have to be added in order to ensure that the path that we move on is kept and speeded up. Final thing, of course, the targets are not there for the sake of targets, but for being able to have the path towards a clean and green energy and energy transition, which basically requires here on the wholesale markets the integration of renewables with fully functioning and liquid intraday markets, balancing markets. And here we saw that still there is room for improvement, let's say. Again, I think we now need to, as regulators in particular, to push that the progress that has been made is not lost in nitty-gritty fights or details, but that the speed of implementing the new rules is maintained, so that we can have the trust that the targets are reached in the end for the benefits of all users, of course, consumers in the first place, but also, of course, industrial users, business users, etc. So we should not forget those and others. This is, I think, the important message here to follow, to continue in the implementation of the new instruments that we all have, and see that the system as a whole functions and integrates more. And I think, of course, new additional rules will be discussed now in the light also of the energy price increases. But as was mentioned by Christian already, there is an analysis that points to the fundamental factors and also indeed to let's say, to the implication if we want to have an energy transition towards net zero, towards climate neutrality, the relative prices will change. And as long as we keep an eye on the market integrity and transparency, which is key, that we do not have market manipulation or insider trading, I think it is a good sign of well-functioning markets that the relative prices change. And also, given the question that I saw on the chat, I think indeed we should keep hands off on price interventions and protect vulnerable consumers in particular with what I would call out-of-market support, like it was also mentioned in ACER's paper, but also in communications from the Commission. I think this is important because otherwise the good start that we have with the new rules might be delayed and even be deviated or prices distorted, and that would in the end cost all of us more than going through this transition. And of course there is a change, and we need to, as I said, cushion those that need protection. But on the other side, all the targets of the Green Deal will only be achieved in a well-functioning, market-based and well-regulated system that accepts the changes that are necessary to integrate an increasing share of renewables, to have an fully integrated internal energy market, and also to implement additional principles like the energy efficiency first principle. I think all these are elements that will bring the progress that is needed to reach the targets. Final point, I think we all saw in the recent developments on energy prices how important it is to monitor markets, and Christian was alluding to this already. And I think also the hour that we have spent together today showed how complex this analysis and assessment is, and how many different factors need to be assessed and need to be weighted to get an analysis on which then policy conclusions can be drawn. There must be a sound database, and that is what we see here in this report, that allows then a thorough analysis, a robust analysis, and the results on which then further conclusions from policymakers can be drawn. I think these are my conclusions, and I would like to thank all of you for attending, and would also like to recall that next week on the 10th of November, there will be another webinar where ACER and CEER will present the consumer and retail market volume of the monitoring reports. I think maybe back to Christian, you to close, or just goodbye for everyone.
Yeah, maybe we do that. We'll let you close, Annegret. Thanks a lot for also those reflections and outward looking principles, which will be a very useful guide, I think, for us in the coming years as we weather a certain number of storms. Thanks a lot for that, and thank you for certainly for the MMR team for putting what I think was an excellent slideshow together, for all those working on this year's wholesale market report, and for all of you who have dialed in. Thanks a lot, and maybe see some of you next week, as Annegret was saying. Thank you. Bye-bye.
Thank you. Bye-bye.